Hello, and welcome to House Lux Estate, the channel that provides you with insights and guidance on real estate investment and financial markets. We're here to help you make sense of the complex world of investing. Whether you're a seasoned investor or just starting out, we'll guide you through the labyrinth of financial markets, shedding light on the intricate workings of the real estate sector and how it intertwines with the wider economy. Our goal is to equip you with the knowledge and tools to make informed decisions. We delve into the nitty-gritty of real estate investment, demystify financial markets, and provide strategies for navigating market volatility. We believe in empowering you to take control of your financial destiny. In our journey together, we'll cover a plethora of topics, from understanding property values to managing your portfolio amidst economic fluctuations. In this episode, we will guide you on how to navigate stock market volatility without losing sleep. Stock market volatility is a term you've likely heard, but what does it mean? Well, in the simplest terms, volatility refers to the degree of variation in the trading prices of stocks over a certain period of time. It's a measure of the speed and magnitude of a stock's price changes. When the market is said to be volatile, it means that stock prices are swinging wildly up or down. This could be due to a number of factors, such as economic indicators, geopolitical events, or even market sentiment. Now, what causes this volatility? There are many factors, but let's focus on three main ones. First is economic data. This can be anything from employment numbers, inflation rates, to GDP growth. When these numbers are better or worse than expected, they can cause significant market movements. Second is geopolitical events. This includes events like elections, wars, or trade disputes. These can create uncertainty, which often leads to market volatility. The third factor is market sentiment. This is essentially the overall attitude of investors toward a particular market or asset. If investors are feeling bullish or positive, it can drive prices up. Conversely, if they're feeling bearish or negative, it can drive prices down. Now, why is understanding volatility important for investors? Because it can significantly impact your investments. High volatility often means higher risk, as the price of your investments can change rapidly in a very short time. This could mean potential for higher returns, but also for larger losses. However, it's crucial to remember that volatility is a normal part of investing. It's not necessarily a bad thing. In fact, some investors see volatility as an opportunity to buy stocks at a discount or to sell when prices are high. To wrap up, stock market volatility is a measure of how much stock prices fluctuate. It's caused by economic data, geopolitical events, and market sentiment, and it can significantly impact your investments. Now that we understand what market volatility is, let's dive into how you can navigate it. When it comes to navigating stock market volatility, a long-term perspective is key. Let's think about it. The stock market is a lot like a roller coaster, full of ups and downs, twists and turns. It's easy to get caught up in the moment, to panic when the ride takes a sudden dive. But here's the thing, just like a roller coaster, the stock market's highs and lows are part of the experience. They're not anomalies, but rather integral parts of the journey. A long-term perspective can be your guiding light through these turbulent times. It helps you understand that volatility is a normal part of the market cycle, not a sign of impending doom. It encourages you to remain calm and patient, even when the market is in turmoil. How does this work? Let's take an example. Imagine if you had invested in the S&P 500 index in the late 90s. You would have experienced the dot-com bubble burst, the financial crisis of 2008, and the more recent COVID-19-induced market crash. Each of these events would have been stressful, to say the least. However, if you had maintained a long-term perspective and held on to your investment, you would still have seen substantial growth over the past 2 decades. Despite the temporary downturns, the overall trend of the market has been upward. This isn't to say that a long-term perspective makes you immune to losses. No strategy can guarantee that, but it does help you weather the storm, to not get swept away by the fear and uncertainty that market volatility often brings. It allows you to see beyond the immediate crisis, to the potential for future growth. A long-term perspective also encourages diversification, another key element of a successful investment strategy. By spreading your investments across different sectors and asset classes, you can mitigate the risk of any single investment failing. This way, even if one part of your portfolio takes a hit, the rest of your investments can help cushion the blow. So when the market gets turbulent, remember to take a step back. Look at the bigger picture. Understand that volatility is part and parcel of investing. And above all, keep your eyes on the horizon, not the immediate bumps in the road. Remember, patience is a virtue in the investment world. If you're looking for the best defense against market volatility, look no further than diversification. Diversification, in its simplest form, is about spreading out your investments across various assets and sectors. It's kind of like having a well-balanced diet. Just as you wouldn't eat only one type of food, you shouldn't invest all your money in one place. Let's break it down. Picture your investment portfolio as a pie. Instead of filling it up with one flavor, you want to have a mix of different flavors. You might have some slices of stocks, a portion of bonds, a piece of real estate, and a dollop of cash. Each of these asset classes has its own level of risk and return potential. The beauty of diversification is that it can help smooth out the ups and downs of the market. When one sector of the market is down, another might be up. This can help offset losses and potentially lead to more consistent returns over time. It's a way of guarding against the unpredictable and reducing the risk of a significant loss. Let's take a practical example. Say you had all your money in technology stocks in the early 2000s. When the dot-com bubble burst, you would have seen a significant drop in the value of your portfolio. But if you had diversified your investments across different sectors and asset classes, the impact would have been much less severe. Diversification isn't about chasing the highest returns. It's about managing risk and reducing the impact of market volatility on your portfolio. It's about finding a balance between risk and reward that suits your individual circumstances and investment goals. Remember, diversification doesn't guarantee profits or protect against all losses, but it can help you navigate the ups and downs of the market without losing sleep. And one more thing, diversification isn't a one-time thing. It's a strategy that you should revisit regularly as market conditions and your personal circumstances change. As the saying goes, never put all your eggs in one basket. Regular portfolio review and adjustment is another crucial step in navigating market volatility. Imagine you're sailing a ship. The sea may be calm one moment, and the next, waves are crashing against your hull. Would you just set your course and never adjust, even with a storm on the horizon? Of course not. You'd constantly check your compass and make necessary adjustments to keep your ship on course. Navigating market volatility is no different. Regular portfolio review is your compass in the financial market. It helps you understand where you are, where you're heading, and if there are any potential risks or opportunities along the way. This isn't about predicting the market's every move. No one can do that. But it's about being aware of your investments, their performance, and the market conditions affecting them. So, how often should you review your portfolio? There's no one-size-fits-all answer. It depends on your investment goals, risk tolerance, and the nature of your investments. Some might find a monthly review sufficient, while others might need to do it quarterly or annually. The key is to strike a balance. Too frequent reviews might lead to rash decisions, while too infrequent ones might leave you unaware of significant market changes. Now let's talk about portfolio adjustment. This is where you rebalance your investment mix to align with your financial goals and risk appetite. If one asset class is overperforming and now represents a larger portion of your portfolio, you might sell some of it off to invest in other underrepresented asset classes. This is not about chasing returns, but about maintaining a balanced and diversified portfolio. Regular portfolio review and adjustment also allows you to capitalize on market volatility. When prices fall, it's an opportunity to buy quality investments at a discount. When prices rise, it's a chance to lock in profits. Remember, the goal here is not to eliminate risk. That's impossible. But it's about managing risk and making informed decisions to keep your financial ship on course. Regularly reviewing and adjusting your portfolio keeps you in the driver's seat, even during market volatility. Let's quickly recap what we have discussed today. We've taken a deep dive into understanding stock market volatility, a phenomenon that can seem daunting, but is a regular part of investing. We've underscored the importance of maintaining a long-term perspective, reminding you that the market's ups and downs are part and parcel of the investment journey. We've also highlighted your best defense against volatility: diversifying your investments. By spreading your investments across different asset classes, you can mitigate risks and smooth out your investment returns over time. And let's not forget the critical role of regular portfolio review and adjustment. By keeping a close eye on your investments, you ensure they remain in alignment with your financial goals and risk tolerance. Thank you for joining us on House Lux Estate. If you found this video helpful, Don't forget to subscribe and stay tuned for more insightful videos. Until next time, happy investing.